The demise of Mike Lloyd's business has been a complicated and heart-wrenching one. After starting his company in 1991 and growing his mini empire of pubs through buying up freehold and leasehold properties, he came under immense amount of pressure to buy up derivatives products from the bank.
We were being pressurised by Barclays to look at a new finance position moving forward, and my partner did most of the dealing with Barclays, and we were told that we had to take out a protection policy, or a loan that would protect the company against interest rate rises, which we thought was perfectly sensible. And when we'd looked back in years gone by, we remembered interest rates at sort of 11, 12, 13%, so we thought it was a sensible thing to do. We had no idea the damage that was going to be done to us if interest rates fell. And when we took out the whole new borrowings in, I think, February 2006, our total borrowings were at that stage something in the region of 6.1 million. We then took out a further swap, which again was made a term and condition of our borrowings in late 2006, which is for another 1.3 million. So we were then effectively hedged to the tune of about 7.3, 7.4 million.
So to put it into perspective, when interest rates fell in 2008, businesses like Welsby's and Lloyds had to pay around £25,000 per month in just swap payments alone.
As we moved forward into 2010, we continued to struggle. We tried to continue to service the swaps, but of course it was getting more and more difficult. We were eventually put into business support by Barclays, which was therefore supposedly going to come and help us to find our way through it. Barclays appointed a company by the name of Begbie's Trainer to come and give us advice and look at the company and see how we could make our way forward, which they duly did. Of course, we had to pay the fees for that, which effectively compounded the problem because we couldn't see that we were getting an awful lot out of that. They also sent in a specialist company to look at the way that the business was being run and to see what the best way forward again was going to be. It was then decided that we needed to sell some properties by Barclays, which we agreed we would do. So we put properties on the market, but as you can imagine, during 2010, at the height of the downturn, properties were not very easy to sell because the banks weren't lending any money. And it took us the best part of 18 months, 24 months to actually get some sales achieved. As time went forward, it became very, very difficult. We started to fall behind with payments to the PAYE and with the VAT, but we eventually kept up with it. Can I just stop a second? Sorry. So we explained to the VAT the situation, and I have to be fair to the revenue. They understood and accepted that we had problems and we were trying to get ourselves out of it.
However, despite a lot of businesses paring down their assets and selling them at fire sale prices, while still being able to prove that they can trade, banks have still retracted their financing and decided to shut them down. In Mike Lloyd's case, he agreed with his bank that they would refinance him in January 2012. However, only a few months later, he received a shocking revelation.
On the 29th of May last year, the money was drawn down, and we breathed a sigh of relief because we had by this stage sold off 4 freehold properties. We had exited the lease properties that we had. We had made a general manager redundant, and by those actions we were actually going to be financially better off by something in the region of £500,000 a year going forward. So we felt we were able to then resolve the situation, come to a CVA agreement with the revenue and our creditors, and we could move on and start to get our lives back again. After the double bank holiday at the beginning of June, which was for the royal wedding, 3 days later, the Inland Revenue issued a winding up procedure against the company. And at that point, Barclays called us into a meeting in central London with their advisors and advised us that they would be withdrawing their support for the company, which we were pretty horrified about. We actually felt we'd done all the hard work over the previous 3 to 4 years and got ourselves into a position moving forward at long last.
Unfortunately, when we got to an August meeting with a bank to discuss these valuation reports, the valuations came back and they had a clear conflict of interest. But not only that, they were actually factually incorrect. So we told the bank, and the bank just said, it doesn't matter, you are insolvent, go and seek some insolvency advice. At which stage we came away from the meeting and went to do just that, because we'd had a pretty torrid 18 months really of a pretty sour relationship.
What concerns me slightly more is this is the tip of the iceberg. Jon's case is quite unique, and it is quite a painful case. It is a complex case, but it sort of embodies, look, this is the worst that can happen. But I've got a whole host of clients at the moment who potentially are in the same situation as Jon. So theoretically, they could go down the same routes as Jon. Because if as a customer, you're in breach of your loan to value covenants, the bank then has carte blanche to pretty much do whatever they want. You're in breach of your lending terms. And in Jon's particular case, they didn't want to work with him. They didn't want to go back and look at the valuation. All they wanted to do was to drive him into insolvency.
When businesses fall into the administration limbo, they will automatically find it more difficult to not only gain redress but go through private litigation, as the businesses themselves are now going through the insolvency process.
Well, I think the speed of redress is a massive issue. We were told 6 months to a year. We're probably 2 months into it now. How they're going to handle all these cases, I do not know. And the damage that slow redress is doing is going to be massive, because it's bringing people back into, you know, Jon and Mike's situation. You know, if this redress doesn't happen quickly, other people are going to slide down the ladder and they're going to be in a different situation.
Because we're outside of the FSA criteria, we instructed a solicitor to look at our case, and they presented that to Barclays. Unfortunately, we didn't get a positive back from them, and it is now in the hands of our administrators as to whether they believe that there is a case. They have appointed a solicitor to look at the case, and it is now in their hands. But unfortunately, out of the number of SWATs we had, there is only one that still fell within the 6-year time statute to enable that claim to possibly be made. The others now fall as time lapsed.
I hope Jon's case goes all the way to court. I hope that I get an opportunity to stand up in court. Certainly what I would hope is that Jon is, would be nice to think he was remunerated in some way or compensated for his loss. He certainly can't be put back into the situation that he's been put in, because as he's articulated to me himself, his property's been sold. The bank have already deconstructed his life. And herein lies the rub for me. If you were to pursue the bank and through the administrators, the monies that you would get would ultimately go back to the bank anyway. The whole situation needs sorting out. We need to address this. There's a derivative swap. We need to address the issues of the way banks treat customers, and also we need to look at. I need to look at my own professional. We need to look at the profession.
And for more on the subject of mis-selling derivatives, don't forget to regularly check out IBTimes.co.uk.